This part of the presentation on financial markets focuses on the 2007-2008 global financial crisis. I'm Pat Obi, Professor of Finance at Purdue University, Calumet. So I'm just going to go there real quick here. And there's a video outtake here that gives you a 30 minutes comprehensive presentation of the causes, consequences, and remedies of the financial crisis. And it's actually posted in my website at patob.com in case you wish to go there sometime. So what I'm going to do here is to give you a quick rundown of it. So now this picture tells it all, which is the situation in the US housing market prior to the crisis. This is a crisis point right here. So you can see that in the 5-year period ending in 94-95, median home prices grew by 9%, and this escalated in the latter part of second half of the 90s during the dot-com boom. It grew by 17%. But look at this. This is our focus point when median home prices in the United States grew by a whopping 60%. And it is in this period between 2000 and 2007 that all kinds of bad things happened. So some of these I'll point to here. All right, and there are three interrelated contributing factors that I point out, including the decline in mortgage underwriting standards by lending institutions, mismanagement of financial risks by banks that were engaged in various forms of toxic financial instruments, and the rapid growth and then collapse of the US home prices, which you see right here. So this is when the bubble kind of bust, and you can see, how things came crashing down. All right, so it was a house of cards, as some pointed to it. So the housing boom that we saw is one that saw home prices growing by a very tantalizing 60%, and that was in large part spurred by um, the use of subprime loans, as I explained here. And the widespread use of subprime loans was a consequence of poor underwriting standards by the lending institutions. And so a lot of people, buoyed by that, purchased properties that they could ill afford, hoping to resell them, as I point out here, at a higher price. So these were called home flippers. So these are all further summarized here. So I write here that as mortgage defaults rose, the value of bank assets naturally fell, as well as the net worth of those banks. And remember, a bank's net worth goes to zero when the market value of bank assets is less than the value of their liabilities, which was the situation leading up to the 2008 financial crisis. So, and it was made worse by the abundance of toxic mortgages. So these were mortgages that were underwater, as well as by some crazy financial products, including collateralized debt obligations and credit default swaps. So some of these we'll touch upon them later on, but CDOs are actually a sort of, these are debt obligations that were taken out in the hopes that the underlying assets would generate sufficient income to back them up. And credit default swaps are actually like an insurance. It's much like you buy an insurance hoping that your neighbor's house would go down, so that if your neighbor's house goes down, then you get paid. So in essence, people were speculating that the owners of the underlying property would go bankrupt, and then they would get paid. More about this will be talked about. I know it sounds weird, but it is true. Um, so the widespread loan default on account of the fact that actually about 50% of the loans made up until the end of 2007 were subprime loans, and many of them, of course, were underwater. The mortgage holders couldn't pay, and so there was widespread home foreclosure. But that in and of itself, I argue, would not have been a problem if banks were able to foreclose a property and then recover from the sale an amount that is at least equal to what they lent out to the homeowner. But in many cases, the home would be worth, say, $80,000, and the bank would receive no more than about $60,000. And so that was a problem that many financial institutions experienced at the time. Loan recovery rates that and loan amounts that were less than what was outstanding. So here I summarize some of the signs of the financial crisis, and these actually came from my published work, which I cite here in the Journal of Global Commerce Research. So they include decline in loan denial rates in banks. So most people who wanted money could get one. All right. So you heard the ad, no credit, no bad credits, no problem. So anyone who wanted money could get it. So decline in net interest margin, of course, banks were losing money hand over fist, and increase in loan to income ratio. And so regardless of how low your income was, you were able to accumulate as much borrowed money as possible. Additional points are also mentioned here, so you can read up on them. But in particular, number 8 here says incomes of loan originators were tied more to the loan volume instead of the loan quality. And so this is the term originate to distribute model that was coined at the time. So originate to distribute is in the sense that you were encouraged more by the size of the loan that you made, knowing that your commission would be higher the larger the loan amount, more so than the credibility, the credit worthiness of the borrower. So poor credit standards. So now this picture here is another telltale. So now in this pre-crisis period when home prices were escalating by 60%, look at what happened in the financial markets. So the blue dotted line is actually VIX, which is implied volatility index that captures market risk, expected market risk actually. Some refer to it as the investor fear gauge. And then the black solid line shows the trend of credit risk. This credit risk here captures the risk premium associated with especially short-term loans. And so it actually measures stat spread, which is the difference between the interest rates on 3-month US Treasury bill and 3-month euro dollar. So as the spread rises, it signifies rising financial risk or credit risk in this sense, in that more and more lenders are unsure about the ability of the borrower to repay the loan. So, but look at this. You see that market risk was actually falling in the immediate years prior to the financial crisis. So it's as if the market was quite comfortable with what happened in the mortgage market. So people were quite okay buying stocks. Stock prices were up to record levels. And but look at credit risk was actually going up. It was telling you that, hey, not all is well in paradise. So it was rising, but these guys, oblivious of that, kept buying up stocks, and so no one cared about credit risk. And that's a disconnect that I think exacerbated the financial crisis, when people didn't care about the riskiness of their investments, when in fact the investment risks were actually going up. Otherwise, as you can see in this period, they usually go in tandem. And of course, when all hell broke loose, they went back going up or going down in moving in tandem, as you can see. Anyhow, so some of these contributing factors are summarized here again. Very low interest rates, especially adjustable rate mortgages, very liberal loan terms, the use of high-risk mortgage-backed securities sold primarily by Fannie Mae and Freddie Mac. Now, these federal-backed financial institutions sold more than one half of the mortgage-backed securities at the time, and were actually encouraged by this legislation called Federal Housing Enterprises Financial Safety and Soundness Act of 1992 to extend a great deal of their mortgage portfolio to subprime loans. But that hurt the economy. This law here, also Community Reinvestment Act of 95, which President Bill Clinton signed into law, also encouraged the extension of loans to individuals who live in low-income neighborhoods. And then, of course, number four, the use of complex collateralized debt obligations. And number five, the use of unregulated credit default swaps, which came into use, or at least were formalized by virtue of the Commodity Futures Modernization Act of 2000. As far as I am concerned, the key culprit of the global financial crisis of 2008 is excessive debt. And why do I say that? Well, look at this picture right here. This shows you the U.S. household debt and disposable income from 1980 to the end of 2008. And as you can see, in general, the red line, which is disposable income, usually plots above the black line, which is household debt. But look at what happened in the focus period I showed you earlier. You can see how household debt, which grew by 11%, surpassed the trend in disposable income, which grew by only half as much. And as a result, you find that this disconnect between how much you owe and how much you earned is essentially the reason why many homes were foreclosed and why banks weren't getting paid, and which ultimately sunk the economy. And some of the major US bank failures we had in 2008 are summarized here. Some of the big mamas were Bear Stearns, AIG, and of course Merrill Lynch, which eventually was acquired by Bank of America. So you can look at the rest of them. And in Europe, it began in 2007 with Northern Rock out of the UK, Fortis Bank out of Belgium, Hypo Real Estate in Germany, and Landsbanki in Iceland. And then, how about the financial market impact? The Black Monday was September 29th, 2008, when the Dow, actually the US financial markets, fell by 7%. And in points, you can see that it was actually the biggest one-day point drop on that particular day. By the end of 2008, the stock market had lost 40% of its value. And that resulted ultimately to the sudden drop in our GDP, which fell by 3%. And then began the Great Recession. Unemployment shot up to the double digits. And this economic weakness, as I indicate here, continued into the late 2011, with unemployment rate staying above 9% for most of that period, and GDP growing even now by 2% or less, now meaning 2015 actually. Alright, and so I show here some of the government's attempts to stabilize the financial system. First was the 2008 Emergency Economic Stabilization Act, signed by President George W. Bush, which provided $700 billion to help distressed banks. And some of the provisions of the bill are summarized here. Many refer to this legislation as Wall Street Bailout Act or bill. And then finally, the Dodd-Frank Wall Street Reform Act of 2010, signed into law by President Barack Obama. And the key provisions of this legislation is consumer protection and the ending of the too big to fail banks. So regardless of how large you are, if you screw up, we're going to let you screw up, kind of a thing. So, but there were also additional strengthening of the capital requirements stipulated by the Basel Committee on Banking Supervision in what we now call Basel III, and the discussion of that will be had at a different lecture. All right, that wraps this up.